Yeah, thanks, Jovinus. My name is Matthew Majinskis. Represent a private investor group based in New York. Besides the Eastern U.S., we focus on property and SME investments across the Baltics and Poland. And for the past couple of years, we've been very interested in the P2P space. One other thing, I actually hosted a similar panel last year at this conference. If you're curious, my surname, it's actually Latvian. It's not Lithuanian. But yeah, so this panel is going to be specifically on peer-to-peer lending, part of the sharing economy. We got a lot to cover, only 50 minutes, but before I kind of give the outline, let's go ahead and meet our panel. So why don't we, actually let's start right here. We have a great pan-Baltic, pan-US panel. Oliver, if you can just tell us who you are and very specifically and briefly what your platform does.
So hi everyone, so I'm Oliver. I'm from an Estonian platform called Pandora. We are currently one of the largest peer-to-peer lenders in continental Europe. We are the largest pan-European platform. We operate in 3 countries, Estonia, Finland, and Spain. We have over 13,000 in retail investors from over 40 countries currently. And we just passed €1 billion in loan originations, of which we have funded over 55 million.
Hi, my name is Martins. I'm from Mintos. We are Riga-based. At Mintos, we are a marketplace where investors go to invest in loans which are originated by non-bank lenders. So essentially, we do not originate loans ourselves. Instead, we create a marketplace where traditionally balance sheet lenders can access funding through the marketplace. Today, 9 non-bank lenders are using our marketplace from Estonia, Latvia, Lithuania, Czech Republic, Poland, and Georgia. And we have around 5,000 investors investing through our marketplace. And because we are a marketplace, we have a wide spectrum of loans available on our marketplace, starting from invoice financing, small business loans, unsecured loans, mortgage loans, and secured car loans.
Just a few words if anybody just walked in, Jason.
Hello. Is this working? Okay. You guys know me. I just presented. But just one thing is our investment firm, NSR Invest, we are not an originator platform like the other guys on the stage. We are a fund that buys loans off of the platforms. So we are buying loans off of Lending Club, Prosper, and Upstart. We're buying consumer loans. And then on Funding Circle, we're buying small business loans.
Hi, Vytautas. I'm the CEO, co-founder of SAVY, the Lithuanian peer-to-peer lending company. We are the biggest and the first ones in the market so far, and we are one of the organizers of this conference as last year. So thank you for coming.
All right, thanks guys. So we're going to talk about 3 broad topics today. The first one that I want to cover is the consumer. Why is this interesting for the borrower? Why is it interesting for the investor? The second thing I want to talk about is the kind of competitive emerging landscape that banks and traditional lenders are facing with the emergence of alternative lending. And the third thing we want to talk about briefly here is regulation. So let's get right to it. Let's start with the consumer, the users of these platforms. Oliver, I want to start with you. Pandora, obviously, it's been around for 7 years. 7 years. First platform in the Baltics, one of the first platforms in the world in P2P. So just straight up tell us, I'm a borrower, I want to take a loan. What is so interesting about Pandora? Why would I come to your platform versus another channel?
So obviously, the easiest thing to say is the ease of use of the platform. So you don't have to leave your house, your home, wherever. You can open up your computer, fill in the application, and receive a decision within hours or minutes even in some cases. So just because the process is fast doesn't mean that the loan is easy to get. We have a lot of very sophisticated processes that are going on, a lot of manual checks, a lot of automatic checks. We check a lot of databases in the countries that we operate. We verify income. So a lot of things that we do with the borrower before we actually say, okay, we will send your application to the marketplace and we will let investors invest in your loan. So as I said before, we just passed €1 billion in origination volume, of which we have funded around 55 million, I think, as of this morning. And so that means that our funding rate for actual people getting loan versus people giving a loan application is just over 5%. So that's kind of a common misconception that, come to our platform, it's easy to get a loan. It's fast, it's not easy.
Absolutely, and congratulations on those numbers.
All right.
Vytautas, same question to you. First platform in Lithuania, I'm a borrower. What is the reason that I'd want to come to your platform?
Well, the things that Oliver mentioned pretty much are similar to us. We check a lot of data. We integrated all the registers available. We call every applicant at least a couple of times. We check the data twice to try to minimize the fraud risk. The main selling point here is that, as one of the representatives of the governmental institution told us that basically there were 150 players in the market until the P2P lending started in Lithuania. 150, but there was no competition at all, meaning that there was the maximum rate, everybody would charge the maximum rate. So there was no competition going on. Once we started to operate, and of course some legislation things, the prices are going down, and they will be going down dramatically, I think for at least a couple of years. And we're not competing with the banks, although our products, part of our products are cheaper than, for example, banking credit cards products. But we see that we are serving the market which is used to get the credit very fast, and we're giving them a really good value proposition regarding the rates.
Okay. Jason, I want to ask you a similar question, but obviously being from the US, and maybe you can give us a view into the future here. But even looking into the future in the US, say the next 3 to 5 years, can you just generally tell us, what do you think the average middle-class borrower looks like? And I know the US is deep, huge, but am I going to go to a bank still to get my home mortgage and maybe go online to get a line of credit for my business or take a personal loan? Can you just say a few words, in your opinion, because you're very experienced, about the financial life of a middle-class borrower in the US, how that looks like in 3 to 5 years?
Okay, so first of all, just looking back, I think that the reason why these companies are doing well right now, there's a mix of industry trends that made this work now. If this was launched in 1999, it would never have worked. There were not enough internet users back then to, this is a business of scale. You need to get to massive scale quickly in order to make it work. So back in 1999, the first Web 1.0, this business would have never worked. There were not enough borrowers or investors to make it work. So it started, like I said, 2005, 2006 is when these companies started to launch. They probably would have not, the recession, the meltdown was probably one of the best things that could have happened to the P2P lending industry, because it caused the banks to retrench, to go more conservative. Also caused regulators to step in and really regulate the banks. As a result, there are a lot of borrowers that are out there that are high quality credit that could not get access to capital. This is both on the consumer side and the small business side. So the timing was fortuitous for these P2P platforms to launch, and they've filled a void in the market that the banks can no longer fill. And as a result, it's both good credit for the borrowers, and it's a good investment for the lenders. So it serves a purpose, it serves a need, and it serves a category that's underserved. How that plays out in the future, I guess the question is, will a P2P platform compete directly with a bank? Well, right now it's filling the gaps where banks don't reach. When it gets larger, does it compete directly with the bank? I don't know the answer to that. Right now it seems more like they are great partners for banks. They are filling gaps in the markets that banks can't reach, and they're partnering with banks to help banks reach those markets as well. So in the near term, we're going to see a lot more bank partnerships. The one that most people reference right now is the JP Morgan On Deck partnership, where On Deck is the white-labeled originator, underwriter, and servicer of the loans. They're taking, well, it hasn't launched yet, but the announcement is they will be taking loans from branches. So when people go into a Chase branch looking for a small business loan, if it's under a certain threshold, that loan will be originated through On Deck with the borrower not even knowing that they're using On Deck. I think we're going to see a lot more of those types of bank P2P lender partnerships happen in the next few years. Another trend that's really important that the US has not really done a good job with, but China's done a great job with is on the mobile side. Probably the best example is what Alipay has done with Yuebao, which basically, it's a wallet, it's a digital wallet online, and that wallet holds, traditionally held your cash. Your cash was held in a bank account. You could access that bank account through the wallet. Well, they put a little button on there that said, okay, you can take your money out of this bank account that's earning you 3%, and you can put it into a money market fund instead that will earn 5%. And in 1 year, they raised $92 billion of money just transferring out of the bank and into the money market account. And this year, they're putting another button in there that says you can take that money out of your money market account and you can add it to your P2P account, and that will generate 7%. So they're just going down it's more risk, but it's also more return. They have to market that properly. But it's all done through mobile. And it's amazing to see just how far the penetration goes with a very simple device that, and a simple interface that does a lot of back-end credit and underwriting. I think that's the future.
Yeah, all good thoughts, thanks. Okay, so that's the borrower side. Let's just go right over to the investor side now. Martin, I want to start with you. Before I do, I want to just sort of paint a picture of how I see an investor, typical investor in the Baltics, maybe Eastern Europe, Northern Europe even. If I'm looking at a place to place my savings, to store my wealth, I generally see two areas. I see property, whether that's personal or investment, and the other is generally in a large bank, typically a Swedish bank. Whether you're wealthy or not, I see pension funds managed there. I see, obviously, deposits, which aren't necessarily attractive right now, but pension funds, privately wealth management there. I don't really see individuals in Eastern Europe with stock accounts, not directly at least, or ETFs. So when you're talking to an investor, someone that wants to save and store their hard-earned euros, why should they go to Mintos and place their capital on your platform?
Sure. First of all, I guess it's probably how we define it's not saving but investing. There's a difference which is also very well basically played out in the UK. Some of the platforms actually market is as a savings. Some of them market invest as an investing. So we definitely think it's investing. Probably we would not compare it to all asset classes. We wouldn't compare investing in peer-to-peer loans to deposits. It's a totally different risk, basically, what you take when you invest in the peer-to-peer loans as opposed to deposits. And this is something which we work quite a bit to educate investors that you should not really compare the two. When you come to Mintos, I guess what we offer as a marketplace is a few things. The first is that it is very easy to diversify, and diversification, cannot emphasize enough how important is diversification in the long term when you want to reach your basically goals with investing. So on Mintos, you can diversify easily. You can diversify. Today, we have loans originated in 6 different countries from 9 different loan originators in many different loan types. So it's probably what number one, which I would emphasize. And then number 2, I guess it's that on Mintos, basically all the loans are originated by already existing companies which have been around for a while, which have been lending through balance sheets themselves. So basically we open up those balance sheets to investors. It's basically a new asset class for investors, which for retail investors, in most of the cases, were not really available. And by opening that up, a new asset class, basically investor gets another exposure to new assets. And the third thing is that because all the loans are originated and pre-funded by each of the non-bank lenders, so there's a better incentive alignment between investors and the loan originator. And we also require each non-bank lender to retain 5% of each loans themselves. So basically, whenever the new loan is issued, investors gonna finance 95%, and the loan originator gonna finance 5%, which brings additional better alignment of incentives that the loans are originated in a good manner.
Okay, great, thanks. Oliver, what about you? Bondora, investor side, I have some money to invest, as Martin said. Why come to Bondora?
So first off, as Martin said as well, diversification is key in any investment strategy. So if you have, I don't know, €1 million of available funds, which is everything you have, then obviously you might be smart move to put something in one class, something in the other, and then also part into peer-to-peer or marketplace lending as well. So obviously the key part in why you should put money into Bondora is yields. Last year, an investment bank did a study and said that Bondora is right now the highest yielding platform globally. With history, so right now we're running at 17% net yield per year. So obviously if you compare that to your average bank savings account, so I just checked this morning that my bank offered me a 3-year savings account with 0.01 interest rate. So obviously that's
good, it's not negative.
Soon to be going negative as well, yeah. So obviously that's the main incentive here is yield. Also, I think it's a good asset class to have, as well as, if you're underwriting loans, we are bypassing the banks. So I think as a marketplace in general, why we exist, or we want to connect different investors with different borrowers. So we want to serve markets that are currently underserved by the current institutions. So if you have, not right now, I think Jason also said before that it started out as a peer-to-peer. Now it's more like a marketplace because we have retail investors, we have institutional investors, we have people investing as a company. So the main reason why I choose Bondora is the new fintech kind of wave to go on. That's a lot of investors are coming on with that. So it's just something new and different than they had before. Plus the yields are great.
Okay. Vytautas, I'm asking you the same question. You get the difficult ones. You've heard from the Latvians, you've heard from the Estonians. Yeah,
I'll take the different approach. With my team, we actually met quite a lot of investors face-to-face and asked the same question, like what's the main incentive here? And a part of what colleagues mentioned is that, yeah, it's fintech, it's interesting, the yields are good. Part of the investors said that, well, I like the social part of this, that I'm really engaging in this lending activity and I feel my activities are good, although 18 or 20 or 25% is not actually not the social responsibility looking from the Western point of view, but here it's really like social aspect. But what I liked the most actually is what we see is that a typical investor is not irrational, actually, in the end of the day. They like the game that they get. And last year, when we were very low on loans that we were accepting and putting into auction, they played the game, who will be first? And it was such an interesting game. We had services around the platform that we didn't control, meaning that one IT guy, he created a service that you could pay like €1 a month, and you could get an SMS once the loan is on auction. Then there will be robots installed on platform that would check the website every 5 to 10 minutes. And these irrational things were the things that were fascinating, actually. We didn't think about it in the beginning. We thought that investors are rational. They look for yield. They look for 10% return, at least 15% return. And our survey says that 75% of investors are happy with the yield below 10%. 10 to 12%, it's like really a sweet spot. 25% wants higher yield. So we are generating better yields than they expected, but they like the game. And this is also the thing that we should take into consideration. Gaming in lending is the approach that is very interesting and new for us.
Okay. Jason, I want to ask you regarding this, as Oliver mentioned, institutional investing. I think in the US, it's probably safe to say the peer-to-peer is sort of being replaced by the marketplace or online direct. You have funds of funds that are investing in these loans. Do you see an opportunity still in the US for the small retail guy to make a good yield, or should he just have a fund manage it and invest on his behalf on Lending Club or Prosper?
No, there's absolutely a opportunity for individual investors to. Okay, yeah, there's absolutely an opportunity for individual investors to invest in the U.S. and P2P platforms. No question about it. It's just like the stock market. If you look at the NASDAQ, for instance, anybody can open up, well, in the U.S., anybody can open up an account at Fidelity or E-Trade or some stock brokerage account, put some money into it, and they can go and they can buy Google and they can buy Apple. And that's a self-directed investor. There's plenty of people that do that. But there's also many people who take their money and put it into a mutual fund. And that mutual fund will go and will buy Google and Apple and build a whole portfolio. Same thing's happening with P2P.
But you would say, just to interrupt, there's probably more security still, though, if you invest this way than versus stocks.
Probably more what?
More security for the investor, would you say?
So
investing actively this way.
Yeah. So I think that if you think about it like a marketplace, then there's going to be all sorts of different styles of investing on that marketplace. Some people are self-directed. They are typically the quants that want to number crunch. They want to take these loans and look at the 500 data fields that are available for each loan. They want to crunch the numbers and figure out which loans are best suited for their investment strategy. You could call it an active investment strategy. There's going to be others that say, I love P2P, I love the returns, I don't want to think about picking loans, so I'm going to put my money into a fund, and that fund will buy loans off the marketplaces. And then there's others that I think is an interesting category that's just popping up, which is wealth management. The wealth management category is really helping retirees. I think this product, the underlying fixed income product, is great for retirees and retirement accounts. And the wealth managers are just figuring out how to build, the P2P firms are just figuring out how to build products and services and technology to integrate into the existing wealth management infrastructure in the US, and through that wealth management infrastructure, reach individual investors in their retirement accounts to offer this product in retirement accounts. I think that's going to be, over the next 5 years, it's going to be a huge area of growth for P2P lending.
Okay. Vitas, did you want to say something?
Yeah, I just wanted to add that one of the things that also we saw in our platform is that we created a super easy to use actual investment tool. There's no entry barrier. The only entry barrier is to have a bank account and to have €5. That's it. So the games could start with €5, and you couldn't do anything with €5 in any investment product in Lithuania at all. And this is what really engages people. There are people, part of investors, they have a small amount of cash available, 50, 100 euros a month, and they invest because this is the only pretty much safe vehicle with relatively high return that they can invest with small amounts. It's very convenient product.
All right, thanks. Let's move on to the second, excuse me, the second topic that I mentioned now. So we talked a little bit about why investors like it, why borrowers like it. Let's look a little bit broader now to the competitive landscape. Traditional lenders, alternative lenders, how do they kind of fit together? Jason said a few words on it, but Oliver, let's start with you. If we look at Europe, we look at the US, you're talking market size, tens of billions have been originated, but this is compared against trillions in terms of addressable consumer, small business, even real estate, credit markets. That's somewhere in the line, if you put all the US, Europe together, 1% to 2%, maybe not even. Europe is below 0.5% probably in market penetration. So where do you see, just if I could get a rough number, do you think that this is going to increase in the next 3 to 5 years to 5% of the lending economy, 10%? Can you give a figure?
Just to give a figure, then definitely I think it can go up to 5%, but it also depends, especially in Europe, it depends a lot on the markets. So I don't know if we have time to give a quick example, but
absolutely, go ahead.
For example, we do lending activities in Spain. I don't know how much you know about Spain, but Spain is a very brick-and-mortar banking system. people go to the bank, physically go to the bank, and the bank is open between 9 o'clock and 2 o'clock in the afternoon. So that's kind of a cultural systems that's been in place for decades already. So now all of a sudden you have the possibility of issuing loans, and you can do it without leaving your house or leaving your home. People just, is that possible? Can you really do it? Is the money really there? Is what's happening to my data? Is it safe? So there's a lot of concerns. So I think the answer most is that all of us here have a lot of work to do in educating the market to make sure that the people or the markets which are more traditional in the banking sense have the courage to take the next step and said, okay, I'll try it online. Maybe it's better. It's a lot faster. It's cheaper. So I think that's the main driving factor, what's going to affect the growth in the next 5 years.
Okay, great. Martin, similar question, but also I know we talk about partnerships. Jason mentioned the OnDeck and Chase partnership. You yourself have many partnerships with, I don't know if you'd call them traditional lenders, but not peer-to-peer lenders. How do you see that growing in your business?
Sure. I mean, when we say partnerships, it's actually those are the non-bank lenders which are using our marketplace. So in a sense, basically, if we strip it out, what it means actually is that there is a non-bank lender, and they've been doing a balance sheet lending themselves, basically then lending from their own capital. Now, with the help of Mintos, they can connect to Mintos platform, Mintos marketplace, and fund loans through the Mintos marketplace. So in a sense, what basically we do, we transform those balance sheet lenders to sort of a hybrid lenders. They're still going to use their own balance sheet, but then they also part of the loans they're going to fund through the marketplace. So in a sense, we are partly transforming them to the peer-to-peer lenders. I see a lot of interest from the traditional lenders, if you say so, to use this marketplace model to fund.
Banks?
Banks, I would probably not. I mean, they have different, of course, sources of capital, how they can access capital. But the non-bank sector, they always have a question of diversification of their source of funding, and marketplace definitely offers one great opportunity for them. So it's basically what it means is that those balance sheet lenders, they don't have to create their own investor-facing platforms. Instead, we create one marketplace. They can do what they do best. It is loan origination. And then by connecting to Mintos, they can sell those loans to investors which are on Mintos platform.
Okay, great. Jason, you want any more comments on partnership, how you see the sector emerging in the U.S.?
I'll just go back to the voids that are being filled again, because I think it's really interesting. If you look at every major platform in the U.S., they're targeting a niche that's not served by the bank. In the case of Lending Club and Prosper, it's an arbitrage against credit cards. Credit cards are not doing risk-based pricing. Basically, whether you are really risky credit or you are Bill Gates, the richest man in the world, if you apply for a credit card, you're going to get a 20% interest rate on that credit card. It's kind of ridiculous, but that's how it's done. And it's done that way because there was no competition for years, and the banks can make a ton of money on credit cards. So as a result, Lending Club and Prosper said, this is dumb. Bill Gates is low credit risk. We don't need to issue him a credit card with 20% interest rate. He could have 2% interest rate, and he's good for it, right? So they're refinancing the prime quality borrowers who have been mispriced by the credit card industry to a lower rate. That's the void that they are filling. That's a huge category. That's a $850 billion market. Of that market, probably $350 billion are prime credit quality borrowers who have been mispriced out of the gate. If you look at SoFi is going after student loans. The government in the US issues all student loans at a 7.6% interest rate. Whether you go to, the University of Basket Weaving or you go to Harvard Business School, you're getting the same rate on your loan, even though the credit quality of the Harvard Business School guy is way better. So what SoFi says is, well, we're going to take the schools that generate the best performance borrowers, and we're going to refinance those loans at a lower rate. Again, they're targeting a niche, and they're fulfilling that niche that's been mispriced to begin with. You look at Lending Home. Lending Home's the leading real estate company. They're looking at borrowers who are non-qualified borrowers, so they don't qualify for a traditional loan. They're typically either an immigrant who's come to the United States, so they don't have a large credit history, but are looking for a loan, and they work for a very good company. They generate good income. They just don't have credit history. Or they're targeting an entrepreneur who may be doing very well, but doesn't have a traditional kind of W-2 kind of salary stream, and they're giving loans to those. And then another area is fix and flips in real estate, where people are buying homes, fixing them up, and flipping them. If you get into the category of $1 million and less in that category, the institutions aren't there. They're not funding those. Those are all done by mom and pop shops. So a realty mogul is going after that segment and taking a fragmented market and streamlining it through technology. So like I'm saying, there's all these little pockets that are not being served by the traditional financial markets. And that's what these P2P firms are doing right now, is they're filling the gaps. And a lot of those gaps are huge. Some of those gaps are small. It'll be really interesting as they actually gain market share and they actually start to fill those gaps. Where do they go next? Do they just jump from one to the next? Or do they actually go head-to-head with the bank? I don't know what's going to happen.
What do you think? Where do they go next? Can you make a prediction for us?
Well, when JP Morgan announces earnings, if you just listen to any one of their earnings, they generate $4 billion in a quarter. That's more than any company generates in, the whole entire industry generates in 5 years. So that's a lot of money. It's really tough to actually displace the large banks. It's kind of unfathomable to think that that's even possible. So I think what ultimately happens is there's a lot of acquisitions, and there will be there'll be a few that emerge and will be legitimate competitors, and then most of them will be acquired and will be parts of banks.
Okay, thanks. Vytas, in Lithuania, let's push this theme of banks, credit unions, traditional lenders. I mean, are they going to find means to cooperate with people like you? Are they going to be competing for a new market? What's it look like?
Well, I like the Jason approach, actually. He mentioned today, earlier, that in the beginning we saw that P2P companies, there was this angle that, yeah, we will beat the banks and we are sort of alternative. And there's no need to beat someone. It's actually, as Jamie Dimon said in recent article in Bloomberg, is that as long as we will give clients what they need, we will be around. And what we see with the banks, part or credit unions, there's a niche that they are not serving. It's these consumers. And this is where the cooperation can be really beneficial for the both part of the alternative lenders, if we can say P2P, and SME lenders, like in the nearest future in Lithuania, where the banks or credit unions, they really don't serve this part because it's too expensive for them, for example, to underwrite a small business loan. And for very micro company, 5,000 euros as a business loan, it's a huge amount of money that they can jump off. So these businessmen, entrepreneurs, they go to payday lending companies in the end, and they charge like 100 APR. It's hilarious. So what we're trying to build is we're trying to get this particular consumer the product that they need. And we started to have this risk-based model, as Jason mentioned. It's really important because we calculate the risk and we charge the person with the risk that we think is feasible. And it's the thing that will grow. What regards my approach, like 1 or 2 years in nearest future, Lithuania, like concrete Lithuania, we have two main players in the market, credit unions and banks. The market is influential by regulation. The regulation is shaping and changing. So what we will see probably in the nearest future that P2P lending companies can and really are able to cooperate with credit unions. Because they're smaller and they are local and they have enough capital. but the regulation is quite tight. Not very much with the banks. Maybe there might be some cooperation with smaller banks in white labeling some of the activities that they don't actually do now. So it's just enhancing their product lines and getting more cooperation there.
All right. I have one general technological question for the panel, and I'll lay it out like this. Basically, I mean, this is a subset of fintech, we call it, which I think is kind of a cheeky term. We're not really sure, are we a financial company? Are we a tech company? What are we really doing? Sometimes I think it's a dismissive term, actually. It doesn't bring clarity. But nonetheless, if you had to define why this industry is so interesting, I would say the biggest tech innovation is the transparent fractionalizing of a loan. So you have one borrower, you can have 1,000 investors, 1,000 lenders. All the interest, all the principal, everything is completely transparent. It's all online, and the platform, yes, you have to trust them to do the underwriting, but it's all transparent and online. And contrast that with, at least in the US, I know, Jason, you're talking a lot about securitization. The US is always pushing this, but you know, during the financial crisis, there was asset-backed securities, pools of loans sold from bank to bank to fund to bank. You didn't even know who the original borrower was, and it was rated AAA. There were issues there. Here, you do not have that. Here, it's transparent. So in my opinion, I think in generally accepted, that's the biggest tech innovation that was in peer-to-peer lending. This is not to anyone in particular. Does anyone have anything that they see coming down the pipe in this fintech industry that's another tech innovation?
Working now? Okay. So as you already mentioned, that the biggest innovation or the biggest advantage we have is the openness. Like in Bondora, the whole transaction ledger is 100% open for anyone to download. Every single application that has ever been processed by Bondora, obviously you won't see who the person was specifically, but you can see all the transactions. So if you're asking whether what the next innovation will be, you know, in the US you have, what we don't have in Europe is a positive credit rating. So you have the FICO score, which everyone can get access to, but in Europe that's non-existent. No one has it. So I think the next piece of the innovation, which is also a lot to do with the regulators and how they handle things, is to force the banks or all financial institutions to the same levels of openness of data. You know, because that will inherently bring down cost of transaction. That will make sure that there's enough competition and true marketplace economy for any credit or any banking product. Because if we had access to the data that the banks have about a customer, then obviously we could do a lot more in pricing the loans, making sure that the borrower is creditworthy or not. Because right now we're trying our best, but it's not a level playing field yet.
Okay, so a bit of a regulatory big data question, maybe. Yeah. Anything else, tech-wise?
Yeah, sure. I mean, fintech and peer-to-peer, obviously peer-to-peer lending is a subset, or marketplace lending is a subset of fintech. So if we talk about fintech as such, I think what hasn't been really done so far, but which is underestimated and which is gonna be a breakthrough, is a blockchain, and one way or the other. I know the banks are fiddling a lot with blockchain. There's been startups popping up in insurance segments using a blockchain. So also marketplace lending could use a blockchain one way or the other. So there's going to be some breakthrough. Is it going to be in the next 2-3 years? Who knows? In the next 5-10 years, definitely. So I really put my bet on the blockchain here.
I would agree. Anybody else?
Yeah, I don't think about it as tech for tech's sake and how that impacts the industry. But I do see one thing that I try to tell every P2P platform that I think can make their business so much better. And that is, you call yourself a platform, but actually behave like a platform and think about yourselves like a platform. And the best example I can give is the Apple App Store, right? That is a platform. You put out that Apple App Store, that platform, you open up the SDKs, and hundreds of thousands of developers are going to that App Store and are developing products and services on top of that App Store. That's a platform. And I tell the P2P companies, think of yourselves like a platform. I think there are 3 elements that make yourselves a platform. Number 1, you need to have You need to have full transparency on your platform. The borrowers need to know what they're borrowing. The lenders need to know what they're lending. You need to know what the middleman, the platform is taking for fees. It has to be really transparent. And that gets back to what Matt was saying about there were securitizations, and at the end of the day, you don't even know who the borrower is. Well, in this case, you know exactly what's happening on the platform. Number two, make the credit that's sitting on your platform, the loans on your platform, give as much information as possible about those loans. Prosper gives 500 variables for every loan. They upload 4,000 loans per day with 500 variables per loan. That's a lot of information that's made available every day. Do that. Make as much information on those loans available as possible, and give the entire history of your lending. Make that available for access by investors. And so that's the data. You've made the data available. You now have a transparent platform with good data. The third piece is open up your platform, open up your APIs, make it possible to trade on that platform. If you can do those three things, open API, historical data, and transparency of the platform, you're going to see lots of interesting things happen on your platform that you hadn't thought of yourself, right? Think of yourself like the Apple App Store. Let people come onto into your platform and develop new products and services that you didn't think of. Let them reach new markets that you may not have thought of. Really think about yourself as a platform. I see very few companies actually doing this, and it seems so obvious to me that that's yeah, absolutely, you guys are doing it. But it's not that common, actually. I think that that's the future for our industry.
Well, blockchain was mentioned, the transparency was mentioned, Ethereum wasn't mentioned, and smart contracts wasn't mentioned. But I won't get into these technical details. We with Matthew met one Chinese hedge manager, big hedge manager in China, and one of the main questions he asked in the beginning was, "Guys, are you a tech company or are you a financial company?" And I don't know how Bondora Mintos would describe you. Are you a fin company, like financial
FinTech
company, yeah, or are you a traditional lender? I don't have an answer to myself, because we like to see that we are like fintech, something doing like with financial, traditional, and with technology. But in the end of the game, I don't know who we are. Either we are like truly technology company and trying to experiment with technology, or we are traditional basic lender doing things quicker, maybe cheaper, and more transparent way. But looking from a trend point of view, I liked a lot last week read that there's a German company. It's a like sort of VC fund, and they started their own bank, and they got a license, and the bank will be dedicated for white labeling. Basically, if you are a fintech company and you need a banking license, you can go to this bank and get this banking license. And I know that last year in Europe, in a couple of platforms, it was for example, they were thinking to scale in Europe using the banking license, and they couldn't find the bank. So 1 year later, now we have this already possibility that you can go to a bank, actually to a company that has a banking license, and maybe use their banking license to scale. And that's a huge thing. And this is where I see the most interesting part is cooperation and opening your APIs. We see Fedor Bank opening their APIs to Ripple. They make international transactions using Ripple. They let a P2P company lend or borrow to each other for their banking system. It's a huge platform, and opening your APIs, it's a big step forward.
All right, thanks, guys. Let's end this section, traditional versus emerging lenders, and sort of what that competition looks like, or cooperation. Just want to talk about interest rates briefly. I think it's no secret, Jason touched on it, everybody knows that the fact that interest rates have been so low after the financial crisis has been an opportunity for investors seeking much more competitive rates, and borrowers also getting actually competitive rates on their side as well. In a rising interest rate environment, however far away we may be from that, do you guys have any thoughts on how that affects your industry?
So obviously you have some investors who are more, less risk tolerant, who will see that as an opportunity. It's okay, I'm going to stop the more risky, maybe 15% yield, and I'll go back to 3. You know, maybe someone is happy with it. I wouldn't be, but maybe someone is. But obviously, if interest rates rise, you know, they rise both for borrowers as well. So I think you will always have better yield opportunities than you will have with traditional, let's say, bank savings accounts. So in our case, obviously, we have risk-based pricing, which means that we cater to a very wide area of different types of borrowers. For example, retail investors, a lot of retail are less risk adverse, so they like to have borrowers from the prime or near prime category. But for example, institutions, you know, they want the more risky categories. So, you know, the higher risk, the better, the larger the interest rates, the better the potential yield. And I don't see that in the near future changing, even if interest rates are starting to rise bit by bit, which they probably won't for the next 5 years anyway.
Okay. Anybody else want to comment on that? It's our last financial question.
Generally, as interest rates rise, the marketplaces will adjust interest rates and will rise as well, generally. But I would say that if you look at the consumer category, when interest rates fell, interest rates really fell for things like your deposit account, which went from 6%, and I'm talking US, I don't know what it is here, but 6 or 7%, 6% for your deposit account to 0.3% for your deposit account.
Very similar.
When rates fell, they really fell. But if you look at your credit card, rates went from 24% to 20%. So the elasticity of the rate decline was much less in credit cards than it was for other areas of consumer credit. And my guess is, and so the spread widened between the credit card and your deposit account, for instance. And my guess is that when interest rates go back up, there will be this, the flip experience where deposit account rates will rise much faster than credit card rates will rise, for instance. So the spread will actually close a little bit. Now, at the end of the day, it's still an interesting spread. There's still a lot of yield there. So I think it's still an interesting investment option. But I think relative to other investment options, it won't be as great as it is now.
Anybody else on that? Okay. All right, let's go to our last topic now, regulation. I think it's pertinent to everybody in the audience, and it is such a new industry. Oliver, you're in three major markets, as I understand, Estonia, Finland, Spain. Can you tell us, if you don't want to talk about Bondora, maybe someone that you've seen, is there, let's get concrete here. Has there been a mistake that you have seen that you've talked with the regulator and you'd be like, yeah, this is a mistake, this is something we need to change from a regulation perspective? You agreed with the regulator.
I don't know about that, but I do have one issue that we do have, and maybe it's Estonian specific, maybe it's a wider issue as well. For example, we have something called the investment account, which you can have as a private person, which you can use to invest in stocks, hold company shares, buy bonds, and et cetera, et cetera. So that kind of, as a private person, it allows you to offset any potential losses and reinvest your profits. So as an investor, private investor in the marketplace lending platforms, you know, they're generally interest earned is taxable. So it doesn't matter, you can't offset any default rates, you can't do anything pretty much. So the interest received is taxable. Whether anyone pays that tax, that's a different issue, but in theory you should. So I think one of the larger aspects is one of the speakers who started this out said, you know, not all financial institutions are created equal. You can't take marketplace lenders the same way as you take banks. Obviously, there's to the sharing economy, there are their own nuances. There are a lot of new aspects to it, and probably the best case of the regulator actually working with the peer-to-peer lenders to develop the best possible outcome for everyone is the FCA in the UK. Because they want to have a dialogue, you know, they want to be in the forefront. If someone regulates something in fintech, they want to be the first ones to do it, and they want to do it well. So that's one of the reasons we actually have an interim license from the FC as well. Even though we don't operate in the UK market, it's a very good rubber stamp for our international investors. That way they can make sure that all our processes, organization structure, the way we underwrite loans or how we process the investments are up to the highest of standards.
Okay. Martin, any thoughts? Regulation challenges, issues that the regulator has come after you, or not you, anybody you've seen in Latvia, and you say, yeah, this is something that needs to be fixed?
Like, first of all, probably that as a non-bank lenders who use our marketplace, they are regulated in each of the markets themselves, so each of them have a specific credit consumer licenses. I don't see any challenges there, actually. But when we look at the regulation in general, I think what has to be said is that a regulation always follows innovation, or putting it the other way around, innovation precedes regulation. And it is a job for regulators probably to catch up and to basically let the industries prosper. Let's see how they work. Because it's very easy to over-regulate from the very beginning and just to say, okay, we're going to regulate this very stringently and not going to help the industry to grow. And I think the FCA in London or in the UK is a good example on the approach which probably Europe should look after. And another issue in Europe, of course, is that it's very fragmented markets. So it's going to take a while, and it's going to take a long while before they come up with a harmonized approach. And today what we see is that, especially on the investor side, less so on the borrower side, because on the borrower side, the consumer credit licensing is pretty harmonized, actually. But on the investor side, we see that because of the lack of this established approach by the European Commission, each of the national, basically, regulators takes their own approach, and that, of course, takes market even more fragmented. So this is probably what's going to take time for the more harmonized approach across the whole Europe.
Jason, how's it going in the U.S.?
Well, just more of an observation about Europe for just a second. Baltics versus
UK?
UK, yeah. UK market, just generally the perception is that this investment, this P2P is really something that's in between. It's not as safe as putting money into a deposit account, but it's way safer than putting money into the stock market. It's a fixed income instrument that is a super conservative instrument that has a lot of downside protection to it. And the yields are not that great. They're 4 or 5%, but there's very little downside risk. Whereas here in the Baltics, it seems like the opportunity is more of an investment opportunity, like you said, with yields of high teens or low 20s returns. It seems much more risk reward. Although I don't know the risk all that well for the Baltics, but it seems to me that the opportunity is being promoted much more like a risky, higher yielding opportunity than a alternative to savings. With that in mind, regulation. Regulation in the UK seems to be working really well, but the product is very different. It's a very conservative product, and they've shaped regulation around such a product. Here, I've heard things like only $5,000 can be invested per person. That seems unfathomable to me, and it seems like a horrible law to me. Obviously, you can't grow your technology companies if you can't get people to invest. Perhaps that has something to do with the way that the perception of the investment here, that it's a risky investment as opposed to a conservative investment. Perhaps the regulation reflects the risk that's perceived in the market. So I don't know what the answer is, but I would say that it seems like there's a correlation between risk and strictness of regulation.
Okay, that's helpful. Thanks. Vytautas, finish it off for us.
Yeah, last year we were unregulated when we were sitting here almost a year ago. Now we are regulated, and there is a separate law and there will be a separate law of crowdfunding within 2 to 3 months, I think. So the market is changing a lot. If getting to the answer that Matthew had in the beginning, where is that we agree with the regulator? We agree that there has to be a regulation. That's for sure. And we were always straightforward here that we have to have the regulation, and there cannot be unregulated market. What we sort of disagree is that when I was discussing with Vytautas from Free Market Institute a couple of weeks ago, I liked his idea that that we tend to put the same the different things under the same regulation, right? So he mentioned it today also, and I understand the regulator that we have separate regulative bodies here in Lithuania. Basically, it's a bank, it's a credit union, it's payday lending company, a consumer provider, and something else. So we are put actually underneath traditional lenders or underneath traditional institutions, although we act separately and differently. And we are regulated actually by the market. If we won't issue loans that are safe, investors wouldn't invest. What we see now, we have probably I'd say 600,000 euros market a month of loans, maybe 10 million a year of P2P loans. It's a 1,000% jump in 2 years, and the market just is growing. And I understand that the regulator wants to understand what's going on, and this is where the breaks come in. Like, okay, 5,000 euros, 2 to 3 years probably. We'll see how the market moves, and either we will remain this, either will not. But will the market will be after 2 years? I don't know. I can't see. Maybe it will be very small.
All right, we're at our 50 minutes. Unfortunately, the conference as a whole run a little bit slow, so we're not going to have time for questions. I just want to finish this off. Very one-word answer. Where is the best country for peer-to-peer lending in terms of regulation right now, Aller?
Probably UK.
Is that the same country after 5 years?
Hopefully Estonia is catching up as well.
All right, Martin.
Definitely the UK, and it's going to be the UK.
All right.
UK.
I don't know about Switzerland.
Well, Lithuania.
I just read the research about Switzerland. They say it's quite good, but probably UK. We have a company there, so it's UK.
All right, that'll do it. Thank you guys very much.